Hello friends, I'm welcome to my YouTube channel Simply Stocks, and today I'm going to talk about Infobeans, a potential mid-cap stock that you can buy as it is only a 1200 crore market cap company. So let's understand about the business and let's understand what you need to do. So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position to any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about Infobeans, a small request that kindly support me on Patreon, and once you do that, it will help me grow the channel, help you also ask me questions in greater detail. Once you get the $10 membership, you'll have access to my portfolio, my watch list, and a number of podcasts that I put up on short-term, long-term calls on markets. Plus, daily you can ask me one query on the markets. And also, if you can pay $100 upfront, you get 1 year access by paying for 10 months. That's a 20% discount. For detailed market or company talk, you can directly contact me on email and we can work things out with a fee. Now, the company established in 2000, Infobeans is into digital transformation and product engineering. It is a very niche IT play, which is into the new age IT domain. Majority of clients are in the financial services, media, and technology, and they boast of a very big market share in this segment, have global presence, and currently the market cap is only 1200 crores for such a business which is globally present and doing businesses into the niche IT space. If you look at the financials, then these are Q4 FY21 numbers. Then sales were flat at you can say 46 crores, but profit went up 10x to around say 10 crores. So this is actually 10 crores versus 1 crore. So this is the reverse of what it is. Zero debt company, high promoter holding, return on equity of 21%, operating profit margin of 28%. So decent, you can say, growth in profitability that has come up because of operational performance that has been pretty good. If you look at the performance, big outperformance in the last 1 year has been nearly 5x from a market cap of 230 to 20 crores all the way to where it is around 1200 crores or something. Have been delivering high margins, and that's why the bottom line has been pretty good, and we are seeing that the numbers look pretty good. Results have been strong but not outstanding, but results have been decent, especially on the bottom line. And you need to understand that in such businesses, numbers tend to be up and down with the kind of, you can say, clientele and order book that the company would be having. Plus there is a level of seasonality that comes in, so profits have consistently increased over years. So year on year, when you look at, numbers look good. Quarter on quarter, there have been up and down in the form of numbers. Valuations are very stretched to an extent, but I think IT will be the sector for the decade. So that's why there's heavy buying in this kind of, you can say, in these stocks, and the valuations are stretched in many of the mid cap and small cap IT companies at the moment. So there is a chance that there will be a decline. There is a chance that there will be some sort of consolidation in the stock. It's not that it is coming on a valuation wise extremely cheap, so you can go ahead and buy, but overall the performance of the company has been pretty good. Why I believe it can be a mid cap in a few years. Expanding margins show high penetration in market. So what is happening in margin is expanding, and I believe that the penetration towards different clients or getting into different geographies segments, that is increasing over time, and that is why probably the stock will continue to do well. At 23 times FY23 earnings, it looks fine, although it is around 40 times current earnings, and that's where the, you can say, the stretched valuations are. So any decline, 10 to 15% decline in the stock is a good buying opportunity rather than buying at current level. And remember that demand for digitization and automation will only increase as we go forward. It is not something which is temporary. This is going to be a permanent shift in many of the businesses that work from home thing, OTT platforms that are being used more by people for entertainment, and there are other ways in which technology are now making a change, whether you're using your fans, your refrigerators, etc., home appliances, and so on and so forth. Things are changing on the ground here in India, and this could just continue. So, demand for digitization of products, digitization of services will only increase going forward. Global business environment looks much better than India. So, as it is an export oriented company, that itself gives it a head start, because India could struggle in terms of growth probably in the next 3 4 years to come back into that 6 7% range. But globally, America and Europe might end up doing extremely well from next year onwards, next financial year onwards. So, global business environment looks extremely positive and huge opportunity once sales increases. Top line growth has been volatile, it hasn't been that great, but bottom line they have performed well. So, once the top line starts working and once all those deal wins come in, and company expands even further, things open up even further in Europe, South America, America, I think we are looking at much better numbers from Infobeans going forward. Yes, next 2 quarters, 1 or 2 quarters, the stock might face pressure, the numbers could be up and down, but overall for the next 4 5 years, we think that the numbers could end up becoming very decent, and hence the company could end up being 20 30,000 crore market cap company even in the next 6 to 8 years. If you look at the technicals of the stock, then it is extremely strong on charts, and I would say a decent, you can say, support is around the 430 440 levels. So it is around 480, so the support is 10 15% lower. Deeper support or greater support is around the 350 level. So one needs to have an understanding that there could be a decline of even 20 25% in these stocks. You cannot just jump in and then think that okay, you will make money. So wait for such kind of declines to 430 420 400 levels to get into these stocks. 350 then becomes a very strong support, and you would have bought it at extremely reasonable valuations, making higher highs and higher lows, and that is a positive. It may consolidate now after such a move that it has taken place. The major big up move is expected above 580. So 580 is perhaps what you should look for. If it is crossing that, then there could be another up move towards 880 900 that could take place in the stock. Otherwise, wait for 420 430 to buy into the stock. So it has risen a lot in last 2 weeks as well. So wait for consolidation and decline in order to buy into the stock rather than jumping in and buying right now. So what needs to be done? Valuation reasonable to accumulate if you look at FY23 estimate, but wait for some sort of a decline to buy. So build positions over time on bad days on markets. When markets fall a lot, then you get in here. Will reward investors by 2026. I think it will take at least 5 years from here to really perform all these kind of small cap IT companies. They won't perform big time straight away, so have to be patient to make money in the IT space and have less than 10% exposure into such stocks. So this was my video on Infobeans. Please like and subscribe my channel, hit the bell icon so you can get my videos straight away when I post it. Thanks a lot for watching.